All right, ladies and gentlemen, it is 11 o'clock, so let's go ahead and get started with today's 1031 Exchange webinar. So I'm going to be your host today. My name is Leonard Spoto. This is me here. I am one of the owners of Asset Exchange Company. And today's webinar is one of my favorite ones. It is called Problems and Pitfalls. So we talk about the 1031 exchange process, but what we really talk about is how to avoid all the problems that can mess up your 1031 exchange. So before we get started, ladies and gentlemen, I have a couple of announcements to make. So first of all, like you, I am working from home, and guess what? I've got a 6-year-old and I've got a 9-year-old, and my 6-year-old's a boy. And what the boy likes to do whenever I'm on a webinar is bust into the office, bring me lizards, force me to make him a peanut butter and jelly sandwich, or just cause havoc. So I'm just warning you, okay? That may happen, it may not, but we'll see, because every day is an adventure when you're working from home and your kids are doing distance learning. So a lot of fun here at my house. The other thing I want to mention is we have the ability for you guys to ask questions. So if while I'm talking, you think, well, geez, I got to ask a question about that. Well, type your question in and it will pop up on my computer screen. All right. And I will answer all of your questions as they are appropriate. And then finally, everybody's going to get a copy of this presentation emailed to them. So there's about 20 slides here. If you want to review these at a later date, we're going to send an email to you. And then we also post all of our webinars on our YouTube channel. So if you want to share this webinar with a client or a colleague, all you have to do is send them our link and we'll provide that to you after the presentation in an email. All right. So how's everybody doing? You guys enjoy those great debates last night? You enjoying working from home, doing distance learning? It's been a kind of crazy year, right? Well, the good news is that the 1031 exchange market is in full swing. We had 3 months, April, May, and June, where we were seeing about 50% of what we should be seeing. But right now, we're back. So we're doing a lot of volume. The real estate market is strong. Interest rates are low. So we are seeing a lot of 1031 exchange transactions. And I'm guessing you guys are too, and that's why you're on this call. So we're going to walk you through some of the things that can go wrong in your 1031 exchange, but more importantly, how to avoid those. Now, if you're looking for a basic 1031 exchange class, this isn't it. Okay, we do a lot of webinars throughout the month. And today is the last day of the month, and we kind of end with an assumption that you guys maybe joined our earlier webinars, so you know the basics. So we don't go through that today. We're just going to go through some of the problems that can come up and how you can alleviate those problems. All right? So let's talk about the biggest problem that happens in a 1031 exchange. All right? Well, let's talk about what a 1031 exchange is real briefly. Okay, 1031 exchange, for those of you who might have missed our basics class, is simply a piece of the tax code that allows you to sell an investment or business use property and defer the capital gain, right? You have to sell a property, you have to go out and buy another property, and if you do so, you avoid paying capital gains taxes. And for those of you who have missed our previous webinars, the tax rate when you sell real estate is about 33% when you combine both federal and state taxes. So this Section 1031 is a powerful wealth building tool. In fact, people call it the single greatest wealth building tool available to investors. So it is a phenomenal tool. We have clients who routinely save or defer hundreds and hundreds of thousands of dollars and sometimes millions of dollars in taxes. So Section 1031, tax deferral for your investment property. Now let's talk about the problems and pitfalls that come up. Problem number one, the single greatest problem people have when they do their 1031 exchanges: unable to find suitable replacement property. All right. So when you do a 1031 exchange, you're going to sell a property, You can defer taxes, but you have to go out and you have to buy a property of equal or greater value, right? What's happening right now in the market is you guys are having no problem getting your clients' properties sold, but when you got to go and turn around and buy replacement property within a compacted time frame, that can be problematic, okay? So what I recommend you do when you do your 1031 exchanges is you start looking for what your client might want to exchange into as early as possible, and you have some backup choices, right? So your client might want to buy a single family rental home in Los Angeles, but those are very tight right now. Not a lot of inventory. A lot of people going out and making bids. You might be number 20 out of 25 bidders on that property. So have a backup. Maybe you might want to look at a Dollar General store or a McDonald's in Albuquerque or a Wendy's in Ohio. All right. Have some backup plans. And when you are doing your 1031 exchange, don't forget your time frame for your exchange starts the day you close escrow. All right. That's day 0. You have 180 days to buy the replacement property, but you have to identify what you're buying on day 45. Now, the problem people have is this day 45 period goes really quickly. So on day 45, you have to nominate what you're thinking about buying, and people start to panic, and they end up putting down properties that they can't eventually exchange into. That is a problem. Okay, I don't want you to panic on day 45. I want you to be in contract before day 45 to buy your property. Now let's take a look at how an exchange works. You're going to actually sell a building. So there's a time before your exchange even starts, usually 30 days when you are in escrow to sell a property, right? Well, those days while you're in escrow to sell can be used to start going out and looking for and making offers on suitable replacement property. So do not think you have to wait until you close escrow to start making offers. You can wait if you want, but you don't have to, all right? Many of my clients will be in contract to buy their replacement property towards the end of their escrow period on their sale, and then they will close and complete their exchange within the first 2 weeks of their exchange. Now, it doesn't always work out like that, but the point is the single greatest problem people have when they do an exchange is finding what to exchange into. So the more due diligence you do up front, the sooner you do it, the better. All right? And I want you to have a backup and another backup. Because you might think, oh, everything's going to go great with the property you're in contract on, and then you do your due diligence on the property you want to buy, and you find out the building's falling apart because there's termites eating away at every part of it. Okay, what's your backup? And what's the backup to that? If you have those backups, if you plan and you have some contingencies in place, you're going to make sure that you complete your exchange. All right, so think about other alternatives, maybe different areas, maybe different types of real estate. You don't have to buy a single family rental home if you sold one, right? You can go out and buy an office building. You could buy a triple net lease property. If you don't know commercial brokers who can sell you or show you these types of investments, we can introduce you to them. It's always good to have a backup, all right? Single greatest problem people have in their exchange is they just can't find good property to exchange into. Number 2. Another problem we have when we deal with our exchange clients is they don't set up an exchange account on time. I probably get 2 or 3 calls a week from people saying, hey, I closed escrow last week and I want to do an exchange. Ladies and gentlemen, that's not how it works. I had a client in this kind of situation. Let's take a look at your computer screen. Client opened up escrow on a $700,000 rental property that he was selling. The client instructed the escrow officer that he wanted to do an exchange. The client assumed the escrow officer was going to set up the exchange account. Well, guess what? They closed on Friday, the deed recorded, the funds got dispersed to the client. No 1031 exchange account was set up. The client called me on Monday, said, well, I want to do an exchange. Sorry, buddy. You owe taxes on that sale. Your escrow company has done their withholding. They have recorded the deed. They sent you the money. You cannot do an exchange if you've already closed escrow. You need to get your 1031 exchange account set up prior to the close. My company will provide instructions to the escrow company, and they will send the funds not to the client, but to the exchange account. Because when you do an exchange, ladies and gentlemen, guess what? You can't touch the money. One of the most important things that we do is we hold funds for clients until they are ready to buy their replacement property. Think about your 401k. You have all these great tax advantages of investing in your 401k, but you can't go and buy stocks and bonds on your own. You have to do it through a custodian. Same thing with the 1031 exchange. We are the custodian for your exchange. The funds from the sale come into the exchange account. There's rules on how and when we can release them. And once you go to buy the property, provided you're following the rules, we release the funds and you don't have to pay those taxes. But you need to get us involved. You can't close on Friday and call me on Monday. That doesn't work. And you might think, duh, we all know that. Well, you don't, because people call me all the time saying, hey, I have a client who closed last week. They want to do an exchange. They heard they had 180 days to go buy something. What do we do? I can't help you. Okay. We need to be involved prior to the close of escrow. Very important. Get your exchange account set up. Very, very important. And I should have done this earlier, is take a look at your computer screen. Okay, this is my phone number. I want you to go ahead and put this number in your cell phone. You can call me anytime. When you need to get your exchange account, if you're closing this afternoon, I can still get it done. All right? Give me a couple days notice just out of courtesy to the escrow officer, because she's going to be upset. But if you are closing this afternoon, I can still get the deal done for you. If you closed yesterday, not going to happen. All right, so use my number, put it in speed dial on your cell phone, and when you got a rush account you need to set up, we'll be able to get that done for you. Ooh, this is a fun one. Let's talk about tax fraud as it relates to 1031 exchange. All right, a lot of people think, well, geez, if I don't do an exchange properly, worst case scenario is I pay my taxes, right? Wrong. When you have a failed exchange, when you get audited by the IRS, you have to prove to the government that you follow the rules. If you cannot prove that you follow the rules, the government is going to disqualify your exchange. They are going to make you pay your taxes, make you pay interest on those taxes, as well as possible fines and penalties. And in the most egregious of circumstances, ladies and gentlemen, you could go to jail for tax fraud related to 1031. Don't believe me? Take a look at your computer screen. There was a real estate agent by the name of Cheryl Savage, who was down in Salinas, California, who served 14 months in prison for tax fraud related to 1031. What did Cheryl do? Cheryl sold a rental property. She bought a new property, a new single-family residence, to complete her exchange. The problem is when you do a 1031 exchange, you have to rent the property out, right? A 1031 exchange is only good for investment properties. So both the sale property and the purchase property need to be used as investments. Can you move into it right away? Absolutely not. But Cheryl did that. Okay, Cheryl moved into the property that she bought in an exchange. And Cheryl's a realtor. She knew how to do exchanges. In fact, on her business website, Cheryl described herself as knowledgeable in 1031s. So here she is telling the public, hey, I'm a great realtor. I know how to do 1031s. But when she did her own 1031, she moved into the new property right away. Now, Cheryl wasn't dumb. She actually knew that wasn't allowed. So what she did was she went and she falsified her tax returns to make it look like there was a tenant in the property. So she was claiming fake rental income on her taxes. So she was telling the government, hey, I've got a tenant in here. Look, there's rental income. But there wasn't, because she was living in the property. Government found out, took her to court, and she ended up serving 14 months in jail. Now, again, you might be thinking, well, this is a really kind of isolated case. People don't do that, do they? They do. I get people who call my office all the time and say, well, Leonard, what we really want to do in our exchange is buy a home to live in. So can we just buy it through the exchange so we don't have to pay taxes and then just make it look like we're renting it out? No, that's tax fraud. Oh, well, what if we do this? No, it's tax fraud. Well, but what if? And then I got to go down the rabbit hole with a client, and I say, no. Rent the property out for at least 2 years to a legitimate tenant. Have them pay you legitimate rent, and then after 2 years, you can boot the guy out, and you can move in, but don't do it any sooner than 2 years. All right? You got to follow the rules. If you don't follow the rules, you've got problems if you get caught. And how many of my clients get caught? Well, every year, about 5% of my clients get audited. So the chances are low, but do you want to be in that 5% and end up visiting Cheryl in the slammer? Probably not. Now, some of you might be thinking, screw it, I'll just take the risk. Okay, go for it. I'm not the tax police. I'm not going to come out to your house and say, oh, no, you're living in the property. But the IRS will. All right? So you got to use the properties involved in an exchange for investment purposes. Yeah, you can eventually move into it, but you need to season it as a rental first for at least 2 years, so there's no question that you use the property as an investment and it qualified for 1031. All right? That makes sense. Now, who can you rent the property out to when you buy it? Well, if you bought a beautiful property right on the beach that you want to eventually move into, you don't want Joe Dirt moving in and messing it up. So can you rent the property out to someone you trust, like your adult child? Sure. You can rent to your 25-year-old or your 32-year-old son or daughter as long as they're paying you fair market value rent out of their own checking account. Can you rent to me? Sure. All right, so there's ways that you can kind of work the law to your favor as long as you do it within the guidelines of the rules. All right? Let's move on. Okay, I just mentioned that you can, in fact, rent your 1031 exchange property to a family member, as long as it is not your spouse, right? You can't say, well, I'll just rent this beach house to my wife and then I'll just visit her all the time. That doesn't work. But you can, yes, you can rent it out to your daughter, your son, as long as they're adults, right? My 6-year-old can't rent the beach house from me. That's not legitimate. But when you do exchanges, buying and selling property between family members is difficult. All right? So let's first, when we're talking about family members, define what that is, okay? A related party for 1031 exchange purpose is your siblings, your spouses, your ancestors, and your lineal descendants, or a corporation where more than 50% of the stock is owned by you. All right? So related parties for 1031 exchange purposes are family members, but also corporations that you control. And if you are buying and selling property in an exchange from a family member or an entity that you own, the government needs to know about it. And on the form that you file reporting your 1031 exchange, they actually say, it's actually section 2. They say, okay, was this a related party transaction? And if so, who is it and what is their tax ID number? And then what they're going to do is they're going to determine if that exchange was valid or not. And here's what they look at. When you do a 1031 exchange, You can only buy your replacement property from a related party if that person is doing their own exchange. So let me give you an example. You're going to sell $1 million apartment building. And what you want to do is you want to buy a property from your mom. All right? So you're going to buy mom's property. Well, that will work if mom goes out and does her own 1031. And it only works if mom does an exchange. So your exchange is dependent on mom's exchange. So let me ask you a question. If you sell your apartment building, can you buy the home your mother lives in to complete your exchange? No. And why is that? Well, because mom can't do an exchange on the sale of the home she lives in. But you could buy a rental property from your mom. So if your mom owns a rental, yeah, you could sell your building and you could buy the rental property that your mom owns, and then she can exchange that. And then you're following the related party rules. Now, this comes up every once in a while, and a lot of times it comes up late in the game. So I opened up a $5 million exchange, and the client was closing escrow in like 3 days. It was a rush order. And so we set it up, and then the client said, oh, I'm buying my property from my son. I said, what do you mean you're buying your property from your son? He said, yeah, he's got this great place he lives in. I'm just going to buy it from him in my exchange. It doesn't work. And he said, what do you mean it doesn't work? I said, it doesn't work. IRS related party rules. You're not in compliance. He said, well, that's ridiculous. I wouldn't have done this exchange if I would have known that. And I said, well, you called me 3 days before your closing, buddy. He said, well, if I would have known this, I wouldn't even have sold my building. And I said, well, what am I going to do? You didn't call me until today. All right, so these related party rules are important, and they're really obscure. People don't know about them. So here's what I want you to think. If you have a client that is trying to do an exchange between a related party before you even list the property, just give me a call. All right, again, put my phone number in your cell phone on speed dial so that in 6 months or in 6 years, when you're talking to the client about exchanges and they happen to mention that they want to do something with their brother, pick up the phone and let's just make sure it's legitimate. All right. Now, so we talked about the first way to do a related party deal is when you buy from a related party, and that works if they're doing their own exchange. Well, what about selling to a related party? Well, that works as long as that buyer who's related to you continues to own the property for 2 years. So you're going to sell your $1 million building, okay, and you're going to go out and do a 1031. But the person who's buying your building is your brother. Okay, that works as long as your brother continues to own the property. He can't go out and flip it. He needs to continue to own it for 2 years. Related party rules, very important. Again, it's one of the first things that will trigger an audit because, again, when you're filing your tax returns, Form 8824 is the form you file to report you did an exchange, and Part 2 of that form says, hey, was this a related party transaction? And if it was, you better fill this out, because if you don't, well, that's tax fraud too. So if you sold to your brother and you didn't fill out this part, guess what? You didn't file your tax returns correctly, and you got a problem. All kinds of wacky stuff, huh? You guys didn't know about this when you took my basics class because we didn't talk about that, right? We didn't dive deep. Well, now we're diving deep, and these things, they're important because they will help determine how your clients may or may not structure their exchanges. What else is important? The government, when you do an exchange, requires that the taxpayer who sells a property must be the same taxpayer who buys the replacement property in the exchange. So normally this doesn't cause any problems because normally property is owned by mom and pop, right? Their names are on title. They're going to sell the building. They go out and they buy a new one in a 1031, and mom and pop put their name on the property. All right, so that's mostly how things are done. Not always, right? But mom and pop sell the property. They say, hey, I'm going to do an exchange. Mom and pop, Fred and Cindy, they go on title to the new property. It's very clear to everybody that the same taxpayer who sold is the taxpayer who's buying. But sometimes that's not the case, right? Sometimes Fred and Cindy call me up and they say, hey, Leonard, we're going to do an exchange. We're going to sell this property and we want to go buy a new one. And I pull up the title report, and Fred and Cindy, their names aren't on title. They have an LLC that's on title. So the LLC is the owner of the property. So I have to call up Fred and Cindy and I say, hey, Fred and Cindy, what kind of LLC is this? Ladies and gentlemen, there are two types of LLCs. You need to know this. One type of LLC is its own taxpayer. The other type of LLC is disregarded for tax purposes, meaning it does not have its own taxpayer ID number. Okay? So you have disregarded LLCs that do not file tax returns, and then you have regarded LLCs, which are their own taxpayers. Whenever there is a property owned in an LLC, I need to know which is it. Because if the LLC files its own tax return, then the LLC is doing the exchange and the LLC must buy the replacement property. So Fred and Cindy can't buy it because they're not doing the exchange. The LLC is. However, if the LLC does not file a tax return, it is disregarded, so the LLC does not exist for tax purposes. It's on title for liability purposes, but it doesn't file a tax return. So even though the LLC is on title, if it is disregarded, then Fred and Cindy can buy the new property in their name if they want to. Does this make sense? Taxpayer who sells must be the same taxpayer who buys. Taxpayers are mostly people, but sometimes they are not people. Sometimes they are LLCs. Sometimes, ladies and gentlemen, taxpayers are trusts. All right? A trust usually becomes its own taxpayer when it becomes irrevocable. All right? What is an irrevocable trust, ladies and gentlemen? A trust that can't be changed. When does a trust become irrevocable? Usually when mom and dad who set it up die, right? The reason why you set up a trust is because you got some kids. And when you die, you want to disperse your assets to those kids in a fair manner, or maybe not a fair manner, right? Maybe Jimmy's going to get one property, but Sue's going to get 10 of the properties. Well, the trust is going to determine that, right? All that's going to be spelled out in the trust. And when mom and dad die, the trust becomes irrevocable, meaning it can't be changed, and the trust files its own tax return. So if mom and dad are dead, you got two properties in the irrevocable trust, and you're going to sell them both and do an exchange. Well, guess who's doing the exchange? It's not the kids. It is who? The trust. So the trust is going to sell. The trust needs to buy the replacement property. The problem is the kids don't get along, and the kids don't want to own the new properties together. So what do? Well, you have two choices. Number one, you just pay taxes. Okay, that's one. You just sell the property and the kids just pay the taxes. Or number two, they break up the trust and they put their own names on title. All right, so they put the properties in their names. And then The properties are not owned by the trust, they're owned by the individuals. The individuals' kids, they sell the property. Johnny takes his money, goes his way, does his exchange, and Sue, the sister, she takes her money and she does whatever she wants with it. Doesn't have to be an exchange. She could go buy a boat if she wants. Very important. Now, of course, you're going to forget this, but you've got my phone number in your cell phone on speed dial already. If you don't, another reminder. And we're going to catch this, okay? Because we're going to pull up a title report. We're going to say, ooh, we got some interesting things going on here. Got to dig a little deeper with your clients. Who is the taxpayer? Helpful if you know, but if you don't, we'll catch it because we're good. That's what we do. Moving along, guys. Guess what? It's 11:30, halfway through. My 6-year-old has not come in with a lizard. We're doing well. This distance learning, right? Kids not interrupting me. I'm pretty happy. Let's talk about boot. Boot, you've heard it. If you've done 1031 exchanges, especially if you're an old guy like me and you've been around the exchange business for a while, people used to call something that was taxable boot. All right? There's different ways you can have a tax problem in an exchange, and you can have some boot. Let me give you an example. All right, let's take a look at a sale of a property that is selling for $500,000. All right, and this is after commission and closing costs. All right, so you're in contract to sell this building for $550,000, but you paid $50,000 in commission and closing costs. All right, so your net sale price is $500,000. This property that you're selling, you have some debt on it. You got about $200,000 in debt, so that means you have how much in equity? $300,000. All right, this property is being sold. You want to do an exchange, so what do? Well, when you do an exchange, you know that you have to purchase property equal or greater in value, right? So you sell a building for $500,000, you go out and you buy a new property for $500,000. But because the interest rates are so low, your mortgage broker convinces you to put as little money down as you can. Guess what, ladies and gentlemen? When you do that, you have boot. That's right. You have cash boot. You have money left over that you didn't reinvest, right? Take a look at my numbers here. You had $300,000 in cash from your sale. You only put $100,000 down, so you have $200,000 of cash left over. Well, ladies and gentlemen, if you don't go out and buy another property, that is taxable boot. And you're going to pay $66,000 to the government. So don't let your mortgage broker, no offense to mortgage brokers on the call, but don't let your mortgage broker who doesn't know the exchange rules convince you not to use all of your exchange proceeds. When you do an exchange, yes, you have to purchase property equal or greater in value, but you also need to use all of your cash as a down payment. All right, there are 2 rules to the exchange. Reinvest all of your cash and purchase property equal or greater in value. You have to do both if you don't want to pay taxes. Now, some of you might be thinking, well, geez, that's fine. I want the $200,000 because I want to go buy a boat or take my girlfriend to Tahiti. So I'm okay with paying the taxes. All right, that's fine. Do what you want. You can always do a partial exchange where you have some cash that comes out and you just pay taxes on that cash. But most of my clients, they don't want to pay taxes. So if you don't want to pay taxes, reinvest all of the cash and purchase property equal or greater in value. Make sense? Well, let's look at another thing, all right? Let's look at another scenario where you could have an unwanted tax bill. Same set of circumstances. You sold a $500,000 property. You got $300,000 in cash coming out of that property, but you went out and you bought $300,000 of real estate only. A lot of people think that all they have to do is spend their cash. We know that that's not the case, right? You didn't buy enough real estate. You didn't replace your debt. All you did was spend your dollars. Well, you traded down in value, so we have what's called debt relief or BOOT, which is taxable. So again, in this situation, we've got a $66,000 tax bill. Some people think that all they have to do is reinvest their profit as well. Some people call me up and they actually get mad at me. They say, well, geez, Leonard, I sold for $500, but I only have $100 in profit. So I'm going to go to Texas and buy one rental property for $100,000. Nope. It's not how it works. What do you mean that's not how it works? Sorry, it's not how it works. They get mad at me, start screaming at me, tell me how ridiculous the government is, how they hate the IRS. Okay, I've heard it all. Just, these are the rules, buddy. If you don't want to pay taxes, you need to reinvest your cash and purchase property equal or greater in value. One more example before we move on. Same set of circumstances, all right? But in this situation, we just traded down in value by $25,000. So we did a partial exchange. We just went down a little bit. Okay, again, not the end of the world, but you're going to have some boot because you went down in value from $500 to $475. So your difference there is taxable, and that's fine. You can pay taxes on a little difference, but just know that you got to write a check to the government come April 15th for about $8,000. Make sense? Now, Dean popped up a question. Can I buy two houses in exchange? Absolutely. Absolutely. So, Dean, you can go out and you can use this $25,000 instead of paying taxes on it. You can go out, put it on down $25,000 on that $100,000 property in Texas. That works. So you bought one for $475, and then you use this to go out and buy a $100,000 property in Texas. So you can sell one, buy two. Absolutely. You could sell three and buy one. So you can do multi-property exchanges. Absolutely. Good question, Dean. All right. Here's another thing that comes up where people like to yell at me. Yeah, I get yelled at a lot. Not just by my wife and kids. My clients yell at me too. People go out and right before they put their property on the MLS, they try to make their property look pretty, right? They put new paint, new carpet, they fix their leaking toilets, repair the deck. And by spending $50,000 before they sell the property, they sell it for a lot more, right? So people are incentivized to make their property look great right before they sell it. But what happens a lot of times when they do an exchange is they say, well, geez, Leonard, I just put $50,000 in doing all these improvements to the property right before I sold it, and I want to pay myself back. Okay, you can do that, but ladies and gentlemen, when you sell a property, okay, let's say we're going to sell it for $500,000. All of the cash, just like in our example, coming out of the sale needs to go where? Into the 1031. So if you take any money out to pay yourself back, guess what? That is taxable. So yeah, you can pay yourself back, but you don't get to do it with tax-free or tax-deferred dollars. The first money that comes out of the property is considered the profit dollars, and they are taxable dollars. You don't get to tell the government, well, no, these are the dollars I put into it, so I'm just going to take those dollars out. Nope, doesn't work like that. The first dollars that come out of the sale are considered the profit and taxable dollars. People hear that, and they yell at me. That's garbage, blah, blah. Well, it's the rules, buddy. All right. Now, you do get credit for all of the money you spent on these improvements. You're going to classify the dollars as either capital improvements, call them CapEx, capital improvements, or as expenses. Now, capital improvements will increase your basis and make your capital gain smaller, and expenses you can write off against rental income. All right, so you do get credit for all of the money that you put into the property, and your CPA is going to classify how the dollars are categorized, right? They're going to say, well, it's either capital improvement or expense. So yeah, you do get credit for those dollars you put into the property. You just don't get to pay yourself back with tax-free money. Make sense? All right. All right. Talk about another thing that comes up. So remember when I said we sold a property for $550, but for exchange purposes, we take out our commission and closing costs. So for exchange purposes, we're looking at a net sale price of $500. Well, what are the $50,000 that you can deduct? Well, they're non-recurring closing costs. And typically those are sales commissions, title and escrow, recording fee, transfer tax, and 1031. Okay? They are what we call non-recurring closing costs, things that don't recur, right? So you can net out anything that you are paying as a one-time expense to sell the property. What you do not get to net out is anything that recurs or anything that is specifically loan related. So what are examples of those? Well, right there. Mortgage prepayment penalties, prorated property taxes, utilities, homeowners, insurance, those things, okay? Now let me tell you why this is a big deal. I had a client who was selling a property in an exchange for $25 million. He had a $1 million prepayment penalty. All right? He wanted to pay that out of escrow, and then he wanted to do an exchange for $24 million. That doesn't work. You cannot pay your mortgage prepayment penalty of $1 million with tax-free money. So here's what happened. I had to pick up the phone, and I had to call this guy, and I had to say, hey, buddy, on your closing statement, it looks like you're trying to pay your $1 million prepayment penalty through escrow. That is going to result in a $330,000 tax bill because it's going to be considered boot. Do you want to pay $330,000? He said, what the hell are you talking about, Leonard? And I said, just said the same thing again. He said, what the hell are you talking about, Leonard? And I said, went around in circles, right? And I said, I know you're not happy with this conversation, but I'm going to save you $330,000 in taxes by having it. So it's a tough conversation to have, but if you don't want to pay this amount of money in taxes, you need to wire in $1 million of your own money to pay this prepayment penalty. He said, you know what? I hate having this conversation, but I'm glad we had it because you just saved me $330,000 in taxes. And I said, yeah, I did. Now, where's my commission on that? And he laughed. And I didn't get paid a commission on that. I should have, but I didn't. All right, so you got to know how the rules work because otherwise you can have a huge unwanted tax bill, right? All of the things that you can pay with tax-free dollars are items that recur. Excuse me, the items that do not recur. They're one-time expenses that you paid to sell the building. Anything that recurs or anything related to the loan, you cannot use tax-free dollars to pay. Does that make sense? Normally, these aren't very big numbers, right? Normally, people don't have $1 million prepayment penalties. So normally, it's not an issue. But it can be. All right? So you might have a client that needs to wire in $1 million to close the property to save a $330,000 tax bill. All right? So these things are important. All right. Let's talk about identification. Identification, as we discussed at the very beginning of the presentation, needs to be done when? On day 45. And identification is challenging because when you identify on day 45, you actually have to physically fill out an identification letter. Ours looks like this. You're going to put your name on it. You're going to put down the properties you want to buy. You're going to sign it, and you're going to date it. And you need to put that you need to put that identification letter in my hands no later than midnight of day 45. So what could go wrong? Well, you don't submit it on time. That's a problem. I don't get your letter on day 45. You've got a failed exchange. What else could go wrong? Well, you could fill out the letter on day 45 stating the properties you want to buy, and you could get none of them. Okay, that's a problem. So day 45 is very, very crucial. As I mentioned prior, I don't even want you to have to identify, because hopefully when you're doing your exchange, you're in contract to buy something back here or maybe even back here, and you close escrow on the new property before your day 45 and you're done. Okay, it doesn't always work like that though, but what can go wrong on day 45? Well, you forget to send me your letter. You fill out your letter incorrectly. So know how to fill out this letter. It's important. You can use the 3 property rule, where you put 3 properties that you want to buy on the list, or you can use the 200% rule, which allows you as many properties as you want, as long as the total value does not exceed 200% of what you sold. Now, we teach a whole class where we go way into detail on these. I'm going to assume you know this. There is an exception to the rule, but I don't talk about it because it really is never used. It's ridiculous. Doesn't make sense. So know how to identify and make sure you submit your ID letter on time. All right? It's important. All right. A couple more things, and then I'm going to answer your questions. Let's talk about seller financing, ladies and gentlemen. Right now, lending is challenging because the lenders are really busy. So some people, when they're selling a property, they say, hey, well, I will be the lender. Okay, I've got $1 million property that's going to be sold. You can give me a $200,000 down payment, and I will carry an $800,000 note. So I'll be the bank. Well, guess what? When you do that, ladies and gentlemen, you are making your exchange difficult, because anytime you carry a note, the only effective way to deal with that note in an exchange is to replace that note with cash out of pocket. All right? So know this. Seller financing is difficult. It will require you to most likely replace the value of the note with cash out of pocket. So if you have a client that wants to do an exchange and carry a note, call me. Guess what, guys? 11:48, and my 6-year-old just came in. Say hi.
To ask you a question.
Okay.
How much
Nope.
should I warm this up?
30 seconds, bud. All right, look at that. Domestic problem solved. He had to microwave his lunch. Got out of that one pretty easy. All right, so carrying a note is challenging. Pick up the phone, give me a call. And where are we? There we are. We're done. All right. So ladies and gentlemen, if you need advice on 1031, you know who to call. If you need advice on heating up your lunch, you know who to call. Right here. This is me. Got my phone number, got my email address, you got my website, and I've got about 4 questions, so we're going to go ahead and answer those. So Robert says, you own 25% of an LLC. Your son and his partner each own a percentage as well. Does your sale of your 25% qualify for an exchange? Okay, so there's a couple of ways to interpret this question. So let's go ahead and I like to draw, so let's go ahead and draw. So Robert's got an LLC. there are three members of the LLC. We got Robert, and we've got his son, and then we got his son's buddy. All right. So when we have a multi-member LLC, ladies and gentlemen, guess what? This LLC automatically is its own taxpayer. And so if there is a property that's owned by this LLC, who's doing the exchange? The LLC. Can Rob sell his share of the LLC to his son and then do an exchange on that? No. Because Rob is not selling real estate. Rob is selling a slice or a percentage of the LLC. And when you sell membership units of an LLC, that is not an exchangeable transaction. So the only way for Rob to be able to do an exchange is to get rid of this LLC and put each of their names on title to the real estate as what's called tenant in common owners, where they can each specify their percentage. And then once they are on title, vested as a tenant in common owner, Rob can sell his portion and do his 1031, and these guys over here can do whatever the heck they want. All right, good question. Okay, so Kier said, what about using $1031 to improve a property? Wasn't going to talk about that. Okay, if you want to do improvements to a property you're buying in an exchange, that requires what's called a construction exchange. You're going to sell a property. Let me start over here. Okay, you're going to sell a property, and in the exchange, when you do the exchange, the money comes to the 1031 company. You now have 180 days to buy your property. So let's say on day 45, you actually close on the property. Perfect. You got some money left over in the exchange account. You can use that money to do improvements, but you have to get them all done and paid for within the 180-day time frame. So construction improvement exchanges are very difficult because of the time frame. They're also very hard to finance, and there's also a lot more cost involved. So yes, you can use $1031 to improve a property you're buying, but it's going to add some cost and complexity to the process. Now, I can send you more information about that. Shoot me an email. We've got several articles that discuss the construction improvement exchange. So Richard says, can improvements that you made prior to the sale be subtracted from the profit? So yeah, I mean, when you do improvements to your property, like we said, you fixed it up, you repaired it, you painted it to make it look pretty for the sale, those are going to be added to your capital, those are capital improvements that are added to your basis. So yeah, they do minimize your profit. Cynthia says, Leonard, you're cracking me up. Well, Cynthia, it's just my life right now. It's not easy. Not easy being a dad with a 6 and a 9-year-old about 2 feet away from me right here. Uh-oh, he's coming over. Uh-oh. Grace says, is there any special loan agent for 1031? Yeah, no, you can get a loan from whomever you want. Now, if you're doing a really tricky exchange, like a construction or a reverse exchange, you might need to go to a private money lender or a kind of a specialty lender. But no, my clients use all kinds of lenders, Bank of America, right, Wells Fargo, anyone. And then last question from Fang. Fang says, if my relinquished property has a mortgage, can I exchange into a property without obtaining a mortgage and pay the difference in cash? Absolutely. Cash is king. So if you want to contribute additional cash to the new property so that you don't have a loan, absolutely, that works. All right. Ladies and gentlemen, that's it. Now, again, very important, put my phone number in your cell phone, put me on speed dial, because you're going to forget all of this stuff in a week, a month, a day, a minute, right? There's a lot of information. If you don't do it all the time, it's just challenging to remember this stuff, all right? So just know that, hey, there's some trigger points in an exchange. and have a good exchange person. Don't call my competitors because they're not as good as me. All right? Okay, maybe they're okay, but you just took my class. Give me a shot, right? So use me as a resource. You got my phone number, you got my email address, you got tons of resources online. So we look forward to working with you guys. Hopefully you had a little bit of fun learning today, and hopefully we can all do deals in the future. Guys, have a safe day, have a good day, and go hug your kid if you got them, even though they're driving you crazy like they do, because that's what they're made for. Ladies and gentlemen, take care. We look forward to doing business with you soon.